If you ever asked any old person ever about any financial advice, they'd probably tell you that buying a home would be the best financial investment that you can make. What they probably didn't tell you is with the 30-year mortgage, the price that you'll pay would be double the price of the house when you include interest and principal. My name is James Travis, and today I'm going to be explaining what home amortization is and how you can find out how much you're going to be paying in full for your mortgage. Home amortization is just a fancy way of saying for every mortgage payment that you make towards your house, some of it goes directly to the principal, other parts of it goes toward the interest. So when I first learned about home amortization, I thought that banks would try to be fair. They'd put 50% toward the principal and then 50% would go in their pocket. It didn't work out that way. So speaking from personal experience, this is what my mortgage payment looks like. On this paper, you can see exactly how much my mortgage goes toward what. So of my $1,420.67, only $217.68 goes toward the principal. The bank takes most of the money, and then the rest of it is escrow. All right, before we go further, there are three definitions that make up the payment of your loan. There's principal, which is the amount that the bank is lending you, the interest, which is the money that they're going to make off of you for having to lend it to you, and escrow is basically paying your property taxes and homeowners insurance. So year to date, I paid $2,251.07 in principal and a little bit more than that in interest. That's only because I've been making extra payments toward my principal. Like I said on this side of the paper, if I were to only make the principal payments, this would be how much I'd be adding every month. To get a good idea of home amortization, we're going to pull up a home amortization schedule. You can find these easily online. All right, let's dive into an amortization schedule calculator. The one that I'm using here is at bankrate.com. This is just going to be an easy way to show you exactly how much money you're going to be spending on a mortgage. Let's say if your mortgage is $200,000 over a 30-month term, and let's say your interest rate was 6%. All right, not including escrow, your monthly payments would be $1,199.10 monthly. So over the course of 30 years, you would end up paying $200,000 in principal and more than that in interest. So you'd be paying in total of about $431,676.38 on your loan. The coolest thing about this calculator is it gives you a couple extra options. You can show the amortization schedule, so it shows you exactly how much each payment goes toward the principal and how much goes toward the interest. So let's say if we stuck with our previous example for $200,000 at a 6% interest rate, of that $1,199, $199 goes toward the principal, exactly $1,000 goes toward interest. Now, if you notice, when you go down every month, you're going to pay $1 more toward your principal, but $1 less towards your interest. Now, of course, banks know what they're doing. This is how they get as much money out of you as possible, but there is a way to beat this system. Let's say if we added $500 a month to your principal, now your principal amount is going up to $699.10, while the interest still stays the same on the first month. But look what happens on the second month. Instead of being $999, now it's dropped down to $996. Doesn't seem like a significant amount of money, but overall your payoff date decreased by 14 years. So by paying off an extra $500 a month, you decrease the length of your mortgage by 14 years. You also decrease how much you're gonna spend by almost half. So instead of paying $230,000 in interest, you basically cut your interest in half by lowering it to $102,000 over the course of the loan. I did give you this higher interest rate on purpose because now I'm going to show you how much money you can save by having a better credit score and qualifying for a better interest rate. So of course, anyone who knows mortgages knows that mortgages often go to the 100th place. I have to say 100th with the TH on the end because it's not the hundreds, it's the 100th. How do I explain that behind the decimal? It's the third number behind the decimal. So let's get a more realistic number. So let's say if your credit score was I'm not going to give an exact number because these change all the time, but let's say if your interest rate went from 6%, which is, you're very high risk, you barely qualify for this mortgage, to something a little bit more manageable. Say we went to 4.892% over the course of 30 years. So let's say if your interest rate went from, instead of having to pay 6% on your interest rate, you pay now 4.892. Your monthly payment is dropped by, honestly, not a lot of money, but your total interest paid is dropped by almost $50,000. And if you, do the math and do the difference between 4.8 and 6, I mean, that's really just 1.2. Lowering your interest rate by 1.2% over the course of 30 years equals $50,000. Like, that's a huge shift. But yeah, if you pay your mortgage off like normal, your principal amount would be less upfront, and then as you get closer toward the maturity of the loan, your principal finally starts to become more than the interest. But it's going to take you 30 years to get there, which is why some people opt for paying a little bit more to their principal so they can pay their loan off faster. So if we apply the extra payments, like I said, it still dropped it down by a number of years. But now that we applied a little bit more money toward the principal, we're paying less than $100,000 in interest. So let's say if we had an interest rate of 4.892, and if we put an extra $500 a month toward the principal every month until the loan was paid off, we would save ourselves almost $100,000 in interest. Another thing that obviously affects how much you pay for the overall cost of the loan is how long you have the loan for. So instead of paying on the mortgage for 30 years, you do 15 years instead. You're gonna drop from $181,000 to just $82,000 in interest. So even if the interest rate stayed the same, which in most cases, if you have a 15-year mortgage, it won't, you would still save over $100,000 in interest. Now, if you looked at the numbers, you realize that if you just paid a little bit extra on a 30-year mortgage, it comes out to be the same thing as a 15-year mortgage. It's only off by $1,000. The real difference is your monthly price. You would have to pay $1,570 monthly versus just $11 when you were doing it for 30 years. If you really wanted to prioritize paying off your mortgage, the biggest takeaway is pay as much money as you can as soon as you can, because the more money that you put toward the principal early on, the lower your total interest amount will be. If you have a mortgage or are thinking about getting a mortgage, always use this calculator to see exactly how much you'll end up paying for the future house that you want to buy. Because in reality, the total amount that you're going to have to buy this house for will be the total principal plus the total interest. And in most cases, if you just pay it off for 30 years straight, you'll end up buying basically 2 houses when you only live in one. Because of course, the bank has to make their share. Of course, as you already know, having a good credit score positively impacts your interest rate, which means you'll end up paying less on the overall cost of your loan. The interest rates themselves were accurate when I was doing the research for this video, but these change all the time. What's more important is you have your credit score between, the best range that you can, so you can qualify for a better mortgage. So you can potentially save yourself tens of thousands of dollars. Buying a house can be one of the biggest financial decisions of your life, so that's why I wanted to make sure that you have all the information that you need to know regarding how much you're going to pay for the overall cost of your mortgage.